What if you could retire knowing you're going to have a guaranteed paycheck for the rest of your life? That's right. There are some 401k plan providers, including BlackRock, which is what we're going to be looking at today, that has a very unique investment plan on how we're going to really combat the future in having a paycheck. Now, we know for a majority of people, when they hit their retirement and Social Security starts kicking in, chances are they'll start taking money out of the 401k or those investment plans. And that is the reason why they have kind of come up with this. The goal is to turn a retirement savings into a fixed lifetime payment through the progression or through the utilization of target date funds embedded with annuities. Now, if you're not familiar with annuities essentially you put money into an investment account and they provide you a monthly paycheck, which is how this is going to happen. And a lot of people are saying, including Larry Fink, which of course is the chief executive officer of BlackRock, that is saying this will one day be the absolute default investment strategy that people are utilizing because of the ability to have a monthly paycheck. Now, when it comes to income, a lot of people that have access to a large amount of money will spend it incredibly fast, not budgeting, not coming up with that plan to how they're going to spend the money, which if you're getting a regular paycheck, that really takes away the need because you're getting enough to essentially supplement Social Security at this point. Now, of course, with this one, there's been a couple companies that they've been kind of testing it with. So what this fund looks like initially, it is a target date fund, which is really the standard of the 401k plans. And I'll go into this a little bit more because personally, I don't believe target date funds really outperform any other investment. When I looked at the majority of Vanguard target date funds that I do offer in my own 401k portfolio, looking at the large cap, the mid cap, and the small cap, investing in those outperformed the target date funds that I had from Vanguard almost twice as fast based on kind of performance. And of course, when it comes to the target date funds, majority of the time, as you start getting into and closer to retirement, your fund allocation will change. So they hold a much riskier, heavy stock portfolio when an employee is young, and then it automatically adjusts the risk tolerance into bonds as retirement age approaches. But overall, when you look at bonds, and you can do your research on this, when we look at bonds, some of those perform at 0.5%, 1%, 2%. When you start looking at bond ETFs, they are absolutely ferocious when it comes to the returns that we're seeing in there. So I don't want any part of my retirement and part of my target date funds that are going to be swapping to the safer funds, because essentially, if you're looking at the full conversion, and they convert about 30% usually by the time you're 65, is that 30%, I am not going to be seeing really any growth at all because inflation is going to far outpace that. Now with BlackRock, they're calling this the Life Path Paycheck. The twist is the fund begins with an annuity contract at age 55. Now we know for a majority of individuals, you don't retire till now it is 67, but 62, 65, 67, they're even looking to up the retirement age to an age of 69, which is incredibly crazy to think, because most people at the age of 70, not only some of them don't have the ability to work because of health or certain situations, but overall that doesn't leave a lot of years left when you actually get into retirement, and also having, again, the health to be able to do things. So what this does is at age 55, it starts converting a percentage into an annuity contract. That allocation grows to 30% of your portfolio at age 65. So thinking about this, and just for nice round numbers, let's say at 55, we have $1 million into our 401k. We're not doing any more contributions. It is going to sit at that $1 million. So essentially every year between 55 and 65, it is going to move 3% into an annuity, which is going to be my monthly paycheck. At the age of 65, 70% of that $1 million portfolio is going to be into whatever I had it allocated into. At 65, you're going to have the option to have 30% of that portfolio into annuities, and that 30% of that portfolio, or that $300,000, is going to be what your paycheck is going to be based off of. For an employee ranging from 59 and a half until they turn 72, you have the ability to build this annuity, locking in a paycheck for your entire life, which is going to be, again, really cool. If you get 30% into that annuity, it is going to be a paycheck for your entire life. That remaining 70% can be invested in stocks, bonds, mutual funds. It can be into whatever they allocate with the 401k. Now, if an employee opts to not buy the annuity, the 30% allocation begins similar to a fixed income allocation in a standard target date fund. So essentially, if you don't want to do this with the annuity, it is going to continue as it always has been, meaning that they are going to slowly mitigate your risk by putting a lot more money into bonds. Now, the problem that lies with this, annuities are incredibly complex. And of course, the other concern is the expense when it comes to managed target date funds, where if we look at something, let's say the VOO, that has a 0.03% expense ratio. A lot of times the target date funds are 0.35, if not a little bit higher. So not only do you have a fund that is underperforming with the target date in a majority of individuals' 401ks, but you also have the other side of it where, again, the expense is very high on that. I mean, you're talking almost 10x from where some of the ETFs are, which again is kind of crazy. Now, of course, with the annuities can also have fees. There are fees in a spread of annuity that individuals cannot see, and they point that out in this article on MSN.com that there are some fees within an annuity that are kind of spread out. And also there are fees in annuity if you take the money out or take the money out before essentially you die away. And of course, this gives me just a lot of questions that they really didn't cover here. Like what if, let's say you're going into this annuity and then of course, at 65, it goes to the annuity, 66, you pass away. What does happen to this? Now, there are some 401k plan administrators like Fidelity that are giving the option to convert savings into institutional priced annuities, retirement themselves. So essentially, BlackRock is going to have a fund that is going to do this itself, where Fidelity is giving you the option to do it if you want to. Now, of course, a lot of people really feel like this could be huge. When you look at your retirement accounts, it is the absolute biggest amount of funds that most people will ever see, with the largest balances, again, that we will ever see. Because if you've been contributing to your 401k 10, 15%, over the last 40 years, you have a massive nest egg that is there. And that is essentially not only to carry you through all of retirement, but that could also be money that you're going to leave to your kids or your grandkids through generational wealth. Now, of course, 401k retirement plans leave workers to figure out the strategy themselves. This is where it is a massive miss. I have a lot of individuals that retire through the state, retire through the county where I live, and we do kind of the financial counseling and education piece. And a lot of workers don't know how to manage the funds. So essentially, let's say you leave your job, your retirement has $300,000 in there. They take that 300K as an IRA or as a withdrawal, putting it into an IRA at a bank, credit union, wherever it may be. With the money, they have to ensure that that 300,000 that they're carrying is going to carry them for the next, 10, 20, 30, 40 years of their life, depending on they retire. And a majority of people run out of money long before they ever hit that date. So essentially, the money is gone at the point, which this is a reason why a fund like this for a lot of individuals would make sense. Because if you're getting 40% of your income replacement from Social Security, let's say you're getting another 20, 30% of your fund replacement from the annuity that you're putting money into. And of course, this, like we said, is a lifetime paycheck. So as more baby boomer regeneration really does retire, 401k plan administrators have to keep things like this to keep money into the plans. Keeping big accounts, giving plans more leverage, more ability to really manage their assets that they have in there. And of course, for individual retirement savings, they're looking and really developing products that are going to make sense for individuals. The Life Path Paycheck Fund are cheap, annual expense ratio of a 0.1, which is awesome because most financial advisors, their expense ratios are at 1% until the annuity contracts at age 55. Then the fee climbs to 0.16, which again is not really a big thing, especially with the annuity that you have in there. Now, looking at the average target date funds, the average ratio that you have, the expense ratio, is a 0.48, which is kind of crazy because most of the funds that are offered at a 0.1, which again is almost 5x what you do have there. So there's very few products similar to the Life Path that BlackRock is doing, but it is the largest uptake so far and starting to see a lot of larger companies that are going this route. Looking at Vanguard, looking at Fidelity, two of the largest target date fund holders in the United States, haven't announced any plans to have a fund similar to this, where it is going to be built in with an automatic annuity. So guys, that is going to do it for today's video. Let me know in the comments what you guys think about the conversion of a 401k, 30% going into that annuity and how it would really affect. Very cool. And again, for a lot of people that can't manage their funds when they get into retirement and making sure that they have enough money essentially until they're past, even if they're living, till 80, 90, 100 plus years old, this is going to guarantee you a paycheck for the rest of your life, which I think is a really cool factor. So again, let me know in the comments what you guys think. And as always, thank you guys for watching.